All right. Hey, trust you're doing well. Really want to just kind of connect together, share what we're looking at, some of the macroeconomic updates that we're taking a look at, and just our various thoughts on it. One, first starting with inflation. Again, we saw the inflation data cooled this past month, 3.4 down from 4.2. So that was a quality or reasonable positive expectation that was realized. The other thing that is a little bit what I'd say is a mixed bag is employment growth slowed down to just 54,000 jobs created. Now, again, what that means is that, it shows the signs that the economy's cooling a little bit. But then you add back in just in the past couple of weeks, they resumed bombing and attack in Iran. And then you saw oil jump from, 70 a barrel up into the mid 80s, and it's hovering around 80 now as we speak. Right now, today we're shooting this, it's the 28th. The Fed Reserve is meeting for their meeting today and tomorrow. They'll release their, decision on what they've decided. Ultimately, what I would suggest is that they're going to hold rates steady. There is a divide within the group about, where they're at and what the plan is. There's kind of a hawkish element to it where they want to raise rates as an offset to help, tamper down inflation. Still, inflation is below where they would want it to be, or, where the guidance would desire it for it to be. Warsh, who's the new chairman, has really taken a position that they're not going to be as forward-telling like Jerome Powell was. I think that, like he said, they're going to let the data speak for themselves and the decisions speak for themselves as well. That's probably a good thing. The bond market and the treasuries already responded to it. And, you see the 10-year treasuries up, 470, give or take, down the 460s. And then that reflects, rates that have gone up for, houses on the 30-year mortgage, as well as for, Fannie Mae, Freddie Mac fixed rate debt on commercial. So, all of that being said, that we're, kind of beating the drum that we've talked about before, that rates are going to be higher for longer. I know there's been a large segment of hope and pray and desire that people want rates to come down. And again, that would be beneficial for everybody. Even Trump has been in the category of, hey, we want rates to come down. Unfortunately, we're just not at a place where we see that happening. And there's not a lot of signs on the horizon that indicate that that's going to be the case. I think it's more realistic that we are in a higher category of rates that will stay that way for a much longer period of time. Now, again, there could be some events where if you had economic slowdown in a dramatic way, job loss in a dramatic way, that could start to tamper the economy, and then that in turn would start to slow, the economy and start to pivot more strongly towards the thoughts of recession. And then typically and traditionally, more money is going to rotate into bonds, and then that would then begin to bring rates down. But I don't think that we see a lot of reasons that stand out for that. You've got the other thing happening, which is the AI boom in spending that's continuing to drive forward, in the stock market and in the actual company spending. We're also seeing that a lot of jobs, though many are being replaced, AI is being implemented along with human beings. And so again, it's going to accelerate the ability for individuals within companies and their efficiencies is what I believe we'll begin to see. So, it's an interesting or mixed bag. And so what does that all mean? It means that, again, you want to have shorter duration elements. You want to be able to look at things for faster executions. You want to be mindful about what's taking place and the impact that it could have. And the reality is, too, there is indication that, the Fed could raise rates, as we said, to help combat inflation. And, that's not likely to happen at this meeting, but it could happen at subsequent meeting in September or, later this year as well. So there is a high probability that you could see even higher rates than what we have right now if we keep going along this track. So that being said, it's a time for being pragmatic. It's a time for being, I don't know if I'd use the word skeptical, but of being, diligent and looking at things through that lens, and then making sure that, what we're moving into or looking at in the form of opportunity is not going to be hurt, or we're factoring in the possibility for higher rates. That being said, we continue to see that there is opportunity in the single-family home market. We see that really continuing to expand because, again, there is, opportunity to purchase things at a significant discount, anywhere from 50 to 60, at times 70% depending on the values of the property. And then we also see in the commercial space that there are more properties coming in the distressed fashion as well. So, definitely it's a time with which we see opportunity on the horizon over the next 12, 18 to 24 months, but one with which you have to be smart in the approach that we take. So I hope you're having a blessed and victorious week, for this is the week God has ordained for you.